A few weeks ago, a story on Fortune.com featured an interview with billionaire investor Stan Druckenmiller. During the interview, he was questioned about the stock market's future and what investors may anticipate in the years to come. Miller's projection, which states that there is a good likelihood that the market would be flat for the next 10 years and that share prices won't experience any growth, was needless to say quite alarming. An imminent recession, the Fed's aggressive interest rate hikes, banks' increased defensiveness, and the ongoing escalation in Ukraine were among the factors given by Druckenmiller for their prognosis. For those who don't know, Druckenmiller has a history of being one of Wall Street's top investors. He started the hedge fund Duquesne Capital in 1981, serving as its founder. For example, Druckenmiller was able to offer investors an average annual return of 30% between 1986 and 2010. According to Investopedia, the S&P 500 has typically offered investors an average annual return of about 8.5%. A family office is a sort of investment organization that oversees investments for exceptionally affluent families, and Druckenmiller turned his hedge fund into one in 2010. His investing methods often involve holding equities for a long time and trading futures and currencies with leverage. Druckenmiller is undoubtedly not the only person with a bad attitude. Other investors like Ray Dalio, Michael Burry, and Carl Icahn have the same outlook on the stock market's future and think that it will experience falls and increased volatility. Some of the biggest financial firms like Goldman Sachs and Wells Fargo also hold this view, though estimates on how long and how severe a drop will last vary. However, pessimism isn't limited to the super rich and the banking sector. Consumer confidence, a gauge of how hopeful people feel about the economy, is currently lower than it was during the 2008 financial crisis. Druckenmiller added that he thinks the markets will function in a manner akin to that of the years 1966 to 1982. If we examine the performance of the S&P 500 over this time period, we can see that for roughly 15 years, the markets were essentially stagnant. There were years when stocks rose significantly, but there were also years when they declined significantly as well. People who enjoy purchasing and keeping stocks for extended periods of time should have avoided this time period because it was necessary to regularly sell your holdings and then buy them back at market bottoms in order to turn a profit. But it's been established time and time again that it's impossible to consistently outperform the market. You hear stories of people who got lucky and bought a stock at a bargain price, making a huge profit, or you hear about people who made a wise investment after doing their homework and due diligence, like Michael Burry, who famously bet against the housing market and made millions off of it. But you don't hear about people who did their homework and did not make a great investment. Dr. Burry also predicted many other things than the property market. A bubble that turned out to be false, but the reality is that this happens frequently. Because people make numerous investments, and when one of them succeeds, you only hear about the successes. Therefore, we must ask, what would be a decent method to generate money in these circumstances if we are in for another protracted period of stagnant share prices in the stock market? You can try to time the market, but given what we just said, it's really more like gambling with your money in these circumstances. What gives you the impression that stocks won't fall much further if you sell them than buy them when you believe we have just reached a low? How do you know whether they won't fly much higher after that before collapsing when you think we've reached a high? And if you're a buy and hold investor like I am, you won't benefit from this kind of market if you're expecting to earn money in a flat market, without having to worry about frequently buying in and selling out to attempt to protect profits. The wisest course of action is to invest in dividends. Strategy entails investing in stocks, ETFs, and other publicly traded securities that periodically distribute gains to investors, usually on a quarterly or occasionally monthly basis. If you aren't retired, you can choose to reinvest all of your dividends into purchasing additional shares of the same stock, which will allow you to earn even more dividends the following quarter, month, or at whatever frequency it pays in a flat market environment. Alternatively, you can take the dividend money and use it to pay for living expenses.
Let me know in the comments if you have any other questions about investing. Let's return to the video.
The only investing strategy that makes sense for someone who wants to make money during lean periods without constantly buying and selling securities in the hopes that they're entering and quitting the market at the perfect time is this one. With the exception of the occasional check to see that the stocks are holding up, it's a more passive way to make money than short-term stock trading, because dividend payments, not short-term share price performance, are what matter most. While all of your growth stock investing pals are worrying and building up losses in their brokerage accounts, you'll be lounging through a flat market. If you've ever had any doubts about the effectiveness of dividend investing, you've probably never seen the graph below from Hartford Funds, who just did research on the subject. There's really no need to explain this because it's so obvious. Depending on whether you wish to include dividends in your calculations when investing in the S&P 500, a $10,000 investment might grow to either $795,823 or nearly $5 million when you reinvest dividends. I find it difficult to comprehend how many investors could look at a graph like this and choose to gamble on high-risk growth firms like Coinbase or Fastly, both of which have had massive declines this year. Personally, I prefer to invest in businesses that give higher dividend yields than 1%. Hence, I prefer to target better-yielding dividend stocks. I prefer investing in equities and ETFs that offer large yields to investors. I do invest in growth stocks, such as those with the ticker SCHD, but almost all of my holdings have an annual yield of at least 5%. The law requires businesses like real estate investment trusts and business development corporations to distribute 90% of their profits to shareholders. While it's important to not only focus on chase stocks offering the highest yields, it's a mistake that dividend investors, both new and experienced, make. It can be very tempting to try to make investments in stocks with outrageously high yields, but these are typically unsustainable. It's not uncommon for these types of companies to offer yields of 5, 7, or 10% or more during current market conditions. You could run into a business like Orchid Island Capital, which offers a ridiculous 18.79 dividend yield and seems like an excellent dividend investment. But upon closer inspection, it becomes clear that the firm has a history of reducing its dividend over time, and that its stock price has lost more than 86% of its value since its IPO. Finally, only time will tell if Druckenmiller's prognosis will come true or not. But during times of stagnant share prices, you need to be careful not to invest in dividend companies that seem too good to be true, like this one. The greatest approach for typical investors to profit from this market is to purchase dividend-paying equities. Compared to constantly buying and selling out of positions, it's the best strategy to pursue. Whether you decide to be a dividend growth investor or more of an income investor like myself is entirely up to you. But contrary to what some detractors claim, dividend investing is a sound investing strategy. If we are headed for a prolonged period of flatlining share prices, then this will be the ideal time for dividends. Stop trying to invest in growth stocks that are advertised on YouTube as having a potential 10 times return. Even if someone does choose a solid stock, no one has ever been able to do so again without having duds in their portfolio. When you stop pursuing all of this hype, you'll start to appreciate dividend or income investing. Companies like Dividend Aristocrats, which have gone 25 years without having to reduce their dividends, are some of my favorite dividend stocks. Examples of some high-yielding dividend stocks would include Realty Income, which has been a reliable company and has never reduced its dividends since its IPO back in 1994. It now offers a dividend yield of just under 5%, but I don't mind given their stellar track record and the fact that the firm pays dividends on a monthly basis. Additionally, WP offers a trustworthy selection that will be a dividend aristocrat the following year. So take a seat back, unwind, and enjoy the dividend income you'll be receiving. And with that, today's video will come to an end.
Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button, and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching.
Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.